Motley Fool reader Robbie asks, explain how to take a company's growth investment into value PE-based investing, Amazon, for example. Hi, I'm analyst Anand Chakavalu, and I'll try to field Robbie's question. So he's referring to PE ratio, which is the price to earnings ratio, which a lot of investors use as an initial gauge on how cheap a company is. But the thing is, you want to pay more for a company that is going to grow more in the future, and you want to pay less for a company that grows less. So PE doesn't really take that into account. So how do we factor that in? So let's use Robbie's example of Amazon as an example. Well, the first thing is, let me introduce a new another metric called the PEG ratio, which is simply the PE ratio divided by its expected 5-year growth rate that a lot of Wall Street analysts provide. What you do is you take the PE, divide it by the growth rate. So if you have a 15 PE and an expected 15% growth rate, your PE ratio would be 1. And I used 1 as an example because a lot of people use above 1 as a stock that's overvalued, and below 1 as a stock that could be a potential value. But as with any metric like PE, the PEG ratio can't just be used as a be-it-end-all metric, and this company's cheap or this company's expensive. So for Amazon, its PE ratio and its PEG ratio are both overstated because of its earnings. Amazon's investing in its growth and thereby depressing its earnings, increasing its PE ratio and its PEG ratio over the short term, because it's investing in things like subsidizing its Prime membership and its Amazon Kindle and its Kindle Fire. So it's purposely lowering its earnings now to try to build a moat in the online retail space. So that's the kind of nuance you have to take into account. And then, to use some blue chips as an example, Coca-Cola and Procter & Gamble, they'll always be a bit high on the PE ratio, not always, but they tend to be, and their growth prospects are lower than some of the more sexy companies out there. But the thing you have to factor in with them is that they're going to be around 10, 20, 30, 50 years from now, whereas a lot of other companies, you can't be so sure that that's the case. So even though they might not be growing as much, they'll be growing over a longer period of time. And then on the flip side, you've got newer companies like, say, Intuitive Surgical or Salesforce.com that you're not sure what their future prospects are. You can project a higher growth rate, but the certainty of that growth rate isn't as certain, of course. So there you have it, Robbie.